Hello again. So as we covered chapter 7, now I'm going over the selected problems to solve them. Okay, so basically problem 3 and problem 5 is required on you. Now let's get started with problem 3, chapter 7, problem 3. So given these specifications of balance sheet for 2 years, we have cash, account receivables, inventory, investment, long-term fixed asset, accumulated depreciation, and the total of it. Also we have here the completement part of this balance sheet, which is account payables, bond payables, common stocks, retained earnings, and treasury stocks overall here. So besides, we have many other transactions over here. Additional data for the period January 1st, year 2 throughout December 31, year 2. So these transactions have been taken place through the second year. Okay. Now, sales on account of $70,000, purchased on account of $40,000, depreciations here, expense paid in cash, okay, including $4,000 of interest and tax, $6,000 of tax, decrease in inventory, sales of fixed assets over here for $6,000, but we have also here $21,000, which is the initial cost of this asset has been sold for $6,000. Also the depreciation is 2/3 of this, which is $14,000. Purchase of fixed assets for cash, okay, so this is cash, $4,000. Fixed assets are exchanged for bond payables of $30,000. Sales of investments for $9,000. Purchase of treasury stock for cash, which is $11,500. Retire bond payable by issuing common stocks for $10,000. Collection of account receivables $65,000. Sold and issued common stock for $1,000 cash. Now, what's the required? The requirement is prepare a statement of cash flow using indirect method, okay, for the year end December, okay, the end of the second year. Okay, so what we have here, this is the answer, but how these numbers have been obtained, some of them is not clear, so I'll go over them one by one and let you know how we collected these numbers from the given data over here. As we said, for indirect income, we start at the top with net income. So net income is not surprising to be here, okay? And we add the other, or deduct the other items as cash, okay? So we add back the depreciation, $5,000, to our cash flow statement, okay? Where is the depreciation? Depreciation is given here. loss on sale of fixed investment. So how we obtained this $1,000 here? Actually, the sales of fixed assets, it's here. Okay, so how we obtained? Okay, the initial price, the initial cost was 21,000 minus. So it's given that the depreciation is 2/3. It means 14,000 minus. Also 6,000, which is the price that we have sold this asset. So if we deduct depreciation and the price from the cost, we will obtain only $1,000 over here. Okay. Now, gains on sales investment. So how we obtain this over here? The investment is here. Okay. But in year 2, it's here, sales of investment. Now, how we obtain that? So the sales of investment for cash, $9,000 minus investments over here, $6,000. So we obtain so this should be deducted from that one. 9. Yeah, so it is $3,000. Okay. Also, we have decreased in inventory for $2,000. Inventory is given here, so we have a $2,000 decrease, the difference between year 1 and year 2. Okay, $2,000 decreased from year 1 to the year 2. Okay, then what else we have? Increase in receivables by $5,000. We have our account receivables over here increased in this one. So this deducted from this, the second year's receivable deducted from the first year's receivables, then we have to obtain minus negative 5,000. Okay, so that was the net cash provided from the operating activities. If you remember, we said we start from the operating activities and then investing activities and then financing activities, finally the net cash. Okay, so now if we sum up from income statement, this one to here, all of them, we end up with 0 from the operating activities. Okay, 0 change from the operating activities, 0 cash. So let's move to cash flows from investing activities. Sales of fixed assets, $6,000. I believe that is given as it is. Sales of fixed assets. Where? Okay, let me find this. Sales of fixed assets. Okay, for cash. Regardless, the depreciation and the cost, those belongs to operating activities. Okay. Also we have sales of investments for $9,000, which is here, sales of investment for $9,000. It's explicitly given over here, very clear. But the important thing is which items to be included under the umbrella of investing activities, which items to be included under the umbrella of financing activities and operating activities. And now purchase of fixed assets. Which is purchase of treasury stock, purchase on the account, purchase of fixed assets for cash. So you may think why this is negative, or you may ask why this is negative. Because the cash has been out, we paid for that. So it's a negative over here. Okay? Minus $4,000. Now, if we add up some of these transactions, $11,000 remains. Okay? Now this can be in thousands, it means 11 millions. Let's move to financing activities over here. So one thing is very important, so you don't think you have to include whatever it's given here. No, you include whatever is required to be included. Okay? Whatever we need to include. And we just let the rest as it is. Because those informations can be used for other statements, for other purposes. Okay, they are given. The items are giving us informations, but they should be used for other purposes. And now cash flows from financing activities, sales of unissued common stocks for $1,000. So we have here, we've sold them, so cash inflow it is positive. Purchase of treasury stock over here, we purchased that, it means we paid for that. Cash out flow negative. We add these two, we end up with negative $10,500. Now if we add this and this and this, all gives us $500. So net increase in cash, net change in cash is $500. So whenever you solve such a question, it's important to know that you can check your answer, the final answer over here. Okay, compare the final answer over here with the given answer over here. Okay, cash $34,500 minus 34,000 will be 500, which is we obtained over here. Okay. I'll move to the second part, B. Prepare, and there are some supplementary disclosures also over here. Interest and income tax for 10,000. These have been paid during those periods. Okay, but we have included them somewhere. We have included them in expense paid in cash. So we don't include those as a cash outflow actually, and that was one of the limitations. But here they have been included over here and would be useful to be included in income statement. Now prepare side-by-side comparative statement. Okay, comparative statement. Comparative statement at the accrual based. Okay, accrual based. So we compare net income and cash flow from operations. Okay, here. So overall sale is here and the collection from customers is here. So this is equivalent to this item in the statement of cash flow, which is already given over here. Collections from receivables. Okay. So gain on investments. Gain on investments, which is $9,000 minus $6,000, ends up to be $3,000. But what is the equivalent of this in the cash flow part? It's omitted because it linked with the proceed of sales of investing activities. Okay, so not in the accrual basis, not in the comparison to the income statement. We don't include it here. So purchases are $40,000 given, and the equivalent is payments to the suppliers. Okay, so how we do it? Purchase of $40,000 is here. Decrease in account payables adds $7,000. Decrease means we've paid a part of this payables. Cash outflow has been there. The cash has been out. Okay, that's how we calculate it. That's how we calculate that one. Decrease in inventory by $2,000. This is also given, and there is no equivalent to this side. Depreciation is given, would be negative in here, but separately we don't have no cash required. I mean, there is no cash activity over here. Okay, expenses paid $18,000. As I said, those has been included. Let me $18,000 including $4,000 of interest and $6,000 of tax income tax, and the sum would be negative also, cash out. Loss on the sale of fixed asset, I think we have been through that, so but there's no cash activity over here linked with the sale of fixed assets, investing activity again. Okay, basically this is comparison of cash flows from operations. So any items belonging to activity of investing and financing will not be included in this table. Now the net income, sum all of these, we end up with 7,000, but cash flow from operations is 0. It's just 0. Okay, the income statement prepared. Okay, this is the answer of the C part. It's not moved through. Which of the two financial reports in B better reflects profitability? Certainly it is income statement which indicates the profitability of the company. Okay, profitability. But cash flow from operations tells us that the company has sufficient cash or liquid assets. In other way, it's telling us information about the liquidity and solvency of the company, not necessarily the profitability of the company. Okay? Very important. I'm now moving to problem 5 over here. The balance sheet and income statement for a company is given, Niagara Company, and the question is asking us to prepare the cash flow statement using the direct method. Okay, using the direct method. So it's here, it's over here, and now sales are given, cost of goods sold, and the rest of the stuff are given here. The thing is important to know how we calculate, okay, where these numbers have been obtained. Okay, so we follow the same structure. We start from the cash flows from operating activities. Sales are given here, but the thing is, sales are 1000 here, but we include only 980. Why? Because we deduct an increase in the receivables from that one. Okay, so 20 out of 1000 sales have been sold on the account receivable. We didn't receive cash out of it. Okay, we are expecting to receive it in the upcoming periods. Here cash payments for operations, purchases of inventory, 645 over here. But why we have here cost of goods sold 650? Now we have cost of goods 650. We add an increase in inventories by 20, but we deduct an increase in payables as well. Okay, our inventory increased by 20, but our payable also increased by 25. So what we can conclude here, this is the amount that has been paid in cash to the suppliers. Okay, this amount has been paid to the suppliers. Okay. We have sales and general expenses over here, and that has been included over here. So this is cash outflow. That's why it's negative. This is cash outflow. We have also interest expense, $40. But why interest expense is 50 over here? Why? One would concern why. Actually, we have to learn. It's not about to be concerned. The interpretation is given here. Interest expense is $50, but less interest increase in the interest payable. Okay, so we paid already 40 of interest expenses in cash, and 10 of it remains the same to be paid in the future. So the cash activity is paying $40 in cash. Okay, and income tax expense also 30, but it is also surprising over here because we have 40, but this is 30. Okay, why? We have income tax expense less increase in deferred income tax. Okay, so deferred income tax, it means we are paying that tax to the government in the future, not now. So out of 40 tax, we paid 30 in cash, not more. Okay, and some of this cash flows from operations is 165, summing all these items over here. Okay, we have cash flows from investing activities. We have only purchase of fixed asset for $150. Let me find it over here. Which is $150 in negative. Okay, let me make it bold, and okay, and where it comes from, it should be here somewhere. It's not from our pocket anyway. Purchases of fixed assets, cash, inventory, fixed net assets. It's here. Current liability, deferred, total equity. So this number is obtained from the change in fixed assets actually. So this amount anyway have been paid to purchase fixed assets. We have also here repayment of notes payables. Repayment of notes payables. And now repayment of notes payables. It's minus $25. The difference between these two. Okay. Issuance of long-term debt. It is 50. We realized one. Cash flow entered the company. Debts. Okay. Difference is over here, and cash dividend paid cash dividend paid. It should be here somewhere. So the difference between retained earnings of this year and the other year. And now cash flows used in financing is minus $5. We sum up all these and we obtain minus $5. Net increase in cash is $10. Okay, so cash at the beginning was 50 and at the end become $60. So $10 increase in net cash. So that was the computation of cash flow using the direct method. Okay, yep, that was all. See you soon. Take care.